ladies and gentlemen, and welcome to the latest edition of the Rasameel webinars. We would always aim to keep you updated with all the latest developments and market trends and investment opportunities. The title of this webinar is The Age of Exponential Growth, as we embark on a technological revolution. We're very happy and proud at Rasameel to announce the launch of our newest fund, the Rasameel Disruptive Technologies Fund. This is the first of its kind in Kuwait, managed in-house and launched under the regulation of the Capital Market Authority to provide investors access to the world of tomorrow, where new technologies are disrupting the status quo and creating the future giants. Exactly 15 years ago from yesterday, Apple announced the development of its first iPhone. Today, the company is valued at $3 trillion. This is the power of disruptive technology. Today, we are going to highlight to you some of the areas where these disruptive technologies will have an impact and what investment opportunities can be created. The Rasameel Disruptive Technologies Fund is based on a portfolio strategy that we have been managing in Rasameel for the past 2.5 years and have returned over 50% over the set period. Through the launch of this new fund, we hope that more investors get access to such strategy and benefit from the great potential it provides. Today, our asset management team will take you through this webinar to highlight to you the opportunity that lies ahead. And as always, you're more than welcome to post your questions at the Q&A section, and we'll make sure to answer as many of them as we can at the end of the webinar. I would like to welcome Mr. Robert Aspen, the head of the team. With him, Mr. Abdul Mahsen Gharaballi, Abdullah Shalan, Abdulaziz Numreikhi, and Sorin Gandhi. Thank you, gentlemen, and I'll leave the floor to Rob to start the webinar.
Thank you, Ali, and welcome, ladies and gentlemen, to the age of disruptive technology and the age of exponential growth without boundaries. And you know, I have to smile when I see that video, and I've watched that video a number of times. The opportunity that we see ahead of us is absolutely tremendous. It is of pretty much unbelievable proportions. And obviously, as Ali was saying, we're very proud to be launching the Disruptive Technology Fund. We've actually been running a disruptive strategy now for quite some time. As Ali mentioned, we've been running it for around 2 years. The performance is up around 50% since June 2019. So this is not anything new to us. And in terms of the companies that we'll be investing in, we're looking for those companies that will break the status quo. And it's across all of the different areas: healthcare, technology, commerce, AI, electric and autonomous vehicles, and others. And hence, I thought it'd be very useful in this relatively short webinar to introduce all of the colleagues that will be covering all of those different sectors. Before I move on to the next slide, I just want to highlight one thing as well, is that, as I mentioned, we've been running this strategy for quite some time, and the year-to-date performance is actually quite good. We're outperforming pretty much every single one of our benchmarks. So hopefully I'll get one of the questions on that we can talk to. Now, what companies will we be investing in? The chart in front of you highlights the traditional S-curve. It's basically the life cycle of a product when it comes to the market. Initially, the product is new, nobody's using it, etc. It then gets slowly adopted and then goes through a very rapid stage of adoption and then matures. So in terms of what we're trying to do, we're looking for those companies that will be starting off, that will be launching their new products, or be in the early adoption stage. Now, typically, the company and the technology will be very much in its nascent stage of development. So these will be relatively small companies that we anticipate will be able to grow into their space and become very large as the technology becomes more and more ubiquitous. In terms of the S-curve that we've seen historically, this is not something new. If you look back in time, all the way back to, for example, when the first vehicles were produced, there was a very slow pickup and then the gradual improvement and then suddenly a rapid increase. And we've seen that with telephony, for example, the old phones, with mobile phones, with apps, etc. I think what's interesting for us today now is the fact that the opportunity set is that much larger. It's significantly larger than the opportunity sets of prior technologies and of prior new products. Why? The world economy is now something like 7.5 billion people. So the world, in terms of the number of people on the planet, has grown massively. It's pretty much doubled over my life cycle. Number one. Number two, the technologies can now be rolled out not just in certain markets like the US or Europe, the developed markets, they can effectively be rolled out globally. So the same product can be available in the US within the same time period, or perhaps a couple of months, it can be available across the emerging markets and China. So the technology can ramp up extremely fast. And as I mentioned, we're looking for the innovators and the early adopters. Now, why Rasameel? Well, that's a very good question. We're based in Kuwait. You can see the team in front of you. We're local. Most of our client base will be based in Kuwait as well. So the beauty here is that you can come and talk to us, you can see us, and we can present our ideas, and we can also talk you through why we like certain ideas. So there's a degree of comfort there. The other thing, as I mentioned, is the fact that we've been doing this now for quite some time. We run different strategies. We also have the global strategy. We also allocate money in Europe and also in the US. And we recently launched our Navigator Fund. So this is now our second fund. And we think the opportunity set, as mentioned, is very large. Now, although we are focused in Kuwait and we're based in Kuwait, we are looking globally. And when I say globally, we're looking across all of the different sectors, all of the different countries, whether it's emerging markets or developed markets, it makes no difference. And we're focusing here on the theme. So as you can see in the little chart down below, you've got the S-curve, that nice blue line. We're, as I mentioned, looking to invest at the beginning of that product cycle. So we're looking for those themes. We're not so much focused on the ups and downs of the economy, on the ups and downs of various companies and sectors and so forth. That's not what we're trying to do in the DT strategy. We're also looking for companies and themes that we can have a very high level of conviction in. And we need to be comfortable that that technology and that company and that theme will play out. So we're not trying to trade the market, and we're looking for longer term investments, something that we can invest in and effectively sit on through an entire cycle, as opposed to, again, a typical strategy, maybe like the global strategy, where we're looking to buy into certain themes, sell out of them as they become expensive and buy into others. We're not trying to do that here in this particular product. In terms of the themes that we're looking at, now we've tried to break this out into 6 different categories, and I think they're all incredibly exciting, actually. So I'll go through this real quick. We've got the robotics and automation. So I think Suren will touch on that in terms of the impact there on e-commerce. We have AI and machine learning. Now, this is obviously an incredibly large area because historically humans were using computers. Going forward, it will be computers self-programming. So it'll be computers learning about the environment that they're in and effectively self-programming. So the technology and the need for semiconductor equipment and software and so on is going to be exponential in terms of demand, and then will impact the entire ecosphere that we're looking at of other disruptive technologies. Down at the bottom there, we've got energy storage and clean energy. Now that's an interesting one because we talk about electric vehicles, we talk about autonomous vehicles. What they require is two things. They need to be able to store energy in order for the vehicle to drive. You need to have a storage of energy in the batteries. So you've got a lot of new battery technology. And then in terms of green technology, it's no good having a battery-powered electric vehicle which is running off coal. So we need to basically bring in green technologies for cleaner energy. And Abdullah will talk to that, some very interesting areas there. And then we got the blockchain, least of all. Now, the blockchain is obviously going to be revolutionary. I think we're already seeing that. It's very much in its nascent stage. Most people will know about Bitcoin and Ethereum, but there's practically a couple of thousand different currencies. And you also have smart contracts. So Suren will talk to this very briefly, but the blockchain we anticipate will basically change the way we do finance in the next 5 to 10 years. And then we have digital health, and Abdul Muhsin will talk to healthcare and the incredible opportunity for disruptive themes within the healthcare space. Now, in terms of looking at some of the companies, I think this is a very interesting slide, and I'm not going to talk to the entire thing, but what we've done here is taken the various themes and we've put them into sector categorizations. So for example, if we start off at healthcare, now healthcare, you've got large companies like J&J and Pfizer. We all know these companies. They've been around for many, many decades. And we actually invest in some of these companies in both the Navigator and also the global strategies. But in the DT theme, what we're looking at is those companies will actually break the current status quo. So a company there that we like, for example, would be Teladoc. Now, Teladoc hasn't been around for decades. It's been around for quite a few years now, but has grown massively, obviously, when COVID struck in 2020 and is still growing. It's not something which is just a blip in the ocean. This is a new technology that we think has a lot of legs. And at the moment, whilst there may be doctors and human beings on the other side of the phone, we anticipate that going forward, individuals will use their mobile phones and effectively link to an AI diagnostic set of tools. So it won't just be phoning a doctor, it will actually be phoning somebody that can assist you remotely, or shall we say something, effectively a computer program that will assist you remotely. Financials, I mentioned that real quick. JP Morgan and other companies like Visa and MasterCard. These companies, again, been around for many, many decades. What's going to break up their hold on the existing market? It's obviously going to be the cryptocurrencies, and we're going to see massive change there. So I think the key takeaway here is that we are looking to invest in these companies that have significant opportunities ahead of them. It is, though, in many cases, the technology will be fairly nascent, and hence the degree of volatility or degree of risk. But I think the opportunity and the potential for these companies to perform well over the next 5 to 10 years is significant. So that's a real quick summary from me. What I'd like to do now is pass it on to my colleague, Suren, who is the e-commerce expert, and we'll talk through that.
Thank you, Rob, and good afternoon to all our attendees. So I wanted to kick off today's discussion by talking about e-commerce. Now, e-commerce is one of the core long-term themes that the disruptive technology strategy is invested in. We like the theme because we believe in the long-term transition from offline, brick and mortar to online, but also because this is one industry that we've seen truly transform over the years. So the notion around e-commerce is that it's selling things online, but the industry has transformed into creating entire ecosystems, both within and amongst platforms. So this graphic that we've created, you see on the screen, is an example of what a modern e-commerce ecosystem looks like. Now, I think this is best understood with an example. So one of the companies that we like is JD.com in China. Our investment in a company like JD effectively allows us to capture multiple growth opportunities across areas like artificial intelligence, machine learning, digital advertising, digital health, automation, robotics, etc. The list is quite expansive. What we truly like about this ecosystem approach is the convergent both within and among different technologies. So Rob actually touched upon the concept of the S-curve. And to just draw a reference of that here, I think the best way to understand or think of this ecosystem is as one S-curve feeding into another, and so on. Now, one very exciting, evolving space, I would say, within this ecosystem is blockchain technology and cryptocurrencies. It's one area of the market where we see tremendous investment opportunities over the coming decade. So if I talk about the size of the market, the crypto markets today are valued anywhere between $2.5 to $3 trillion. 2021 was a phenomenally good year for cryptocurrencies, and Bitcoin actually was up over 60%. And despite this growth, the overall size of this market is, I would say, minuscule when you compare that to the equity markets or the bond markets, for example. So with higher retail participation and much larger institutional interest, we think there lies an enormous market opportunity going forward. Also, I would highlight that we're in the very fairly early stages of adoption and using these technologies. But what's clear so far is that adoption rates are very high. In fact, it was higher than 100% last year, and it's happening. The transition is happening even faster than what we saw in the internet adoption age of the 1990s. Now, I think this graphic that we've displayed on the left-hand side of the screen shows how this theme is a great fit within the S-curve dynamic that we spoke about. Now, as adoption rates increase and newer technologies emerge, we believe that this industry will continue to grow. And this ecosystem that we've created will continue to expand. It's going to include a lot more areas of investment that we are not even aware of at this point in time. But given the risk and the nascent stage of a lot of these investments, we believe it's very important to be focused around what you're investing in. Our focus at Rasameel, though, it revolves around investing in those technologies where we see a path to commercial adoption. So on that note, let's have a look at this e-commerce ecosystem. If I start off from the top left, I talk about digital currencies. Now, this is one area that's already entered into commercial adoption stage. We're seeing the application of digital currencies across online lending, money exchange, and e-commerce, just to name a few areas. On the top right, I talk about smart contracts. Now, smart contracts are just contracts that are based on the blockchain, and they're based on preconceived notions that will start executing the contracts as and when these conditions are met. Companies like IBM have already begun offering smart contract-based solutions to their client base. Finally, if I talk about the bottom right, it's a fairly new concept on the record-keeping side, but I think we're all aware of NFTs, and our focus, though, more is on the underlying technology behind NFTs. That's where we see the opportunity. And this market actually got a huge boost recently, just late last year, when the big tech companies, especially Meta platforms that was previously known as Facebook and Microsoft, laid out their vision of the concept of the metaverse. And they clearly highlighted the use case and the opportunity that these technologies would play inside the metaverse. So in summary, I think it's fair to say that this is one of the most exciting places within disruptive innovation, and we believe some degree of exposure to this space is warranted. So I spoke about the metaverse just a while back. So just to touch upon what the metaverse is and what it's going to be. At this point in time, we know very little about what the end state metaverse will be. However, what we do know is that it's going to be a convergence of the best of our physical and our digital infrastructure. One thing we know from the companies that are going to be developing the metaverse is that there is going to be a huge focus on providing experiences inside the metaverse. We think that gaming is going to be one of those key experiences, and it's one industry that we are actively invested in. So if I talk about the size of the gaming industry, I think a lot of us would find it fascinating, to be honest, that the gaming industry is actually bigger than both the movie and the music industry combined. Now, this is tremendous growth from just half a decade back, when the common notion around gaming was that gaming is meant for teenagers. The industry has come a long way since then. And I think with the onset of COVID, that the demographic mix for gaming has completely changed. I would also highlight the transformative nature of this industry. So here's what I mean by that. I think a lot of us would actually relate to playing Pac-Man games in the arena. And then this transition into PC gaming, then into console gaming. And today we are in the era of mobile gaming. It is this exact transformative nature of the industry that we appreciate. I think it's important to highlight another potential aspect that we like, and that is the monetization potential of the gaming industry. I think the gaming industry is very under-monetized at this point in time. I say this because the gaming industry actually sits or forms a small part within the overall entertainment industry. Now, we are very positive on the spend on entertainment going forward, and we think that gaming as an industry has the potential to take a much larger share of the pie going forward. Just to give an example, if you look at, and it's very interesting to note this, that if you look at the per hour cost of gaming, it actually is around 20 cents per hour. This is a 50% discount to its closest peer, that would be video streaming, for example, on Netflix, or audio streaming, for example, on Spotify. This discount gets even more larger when you compare it with other offline sources of entertainment. So the potential for increasing monetization is massive. I would also highlight this interesting fact that gaming is probably the only industry within entertainment which gives you a different experience every time you engage in it. So coming back, driving the discussion back to the size of the gaming market and the biggest players, it's clear that while mobile gaming today is the fastest growing segment of this industry, we think that cloud gaming is going to be the next leg of growth over the coming decade. It's a market which is in the very early or nascent stages, but it's expected to grow at a 48% CAGR over the coming years. So why do we like cloud gaming? We like it because of the value proposition that cloud gaming provides. Now, cloud gaming essentially takes away the hardware component from the gaming situation. In fact, a lot of gamers would relate to this, that access to high quality or high spec hardware is a big deterrent or barrier to entry for a lot of gamers. With that out of the picture, cloud gaming essentially allows gamers to seamlessly transition across different devices, and this provides them with a much better, faster, and a more immersive gaming experience overall. When I say seamlessly transition, I'm actually talking about your ability to start the game on your mobile phone, quickly move over to the iPad, move over to the console, move back into the living room TV, and so on and so forth, and you would still be inside the game, playing it in the same quality. This is phenomenal. So within the disruptive technology strategy, I would say that we are invested across companies that we believe will see massive tailwinds from this changing industry dynamic over the coming decade. With that, I pass on the discussion to my colleague, Abdulaziz Mureki. Thank you.
Thank you, Surin, and thank you all for your time in joining this webinar. So I'm here to talk about the autonomous and robotics revolution. And this is a technological revolution that is transforming every aspect of our lives through none other than automation. I think there's no denying that society is undergoing a third social phase change. And with the first being the agricultural revolution, the second being the industrial revolution, and we are now very much in the midst of an autonomous revolution. Now, this autonomous revolution is being driven by two major parallels. The first being the intelligence parallel, which is the reality that we are using intelligent machines today and smart robots to replace human labor. So machine learning today has reached a point where machines are able to adapt and learn faster than humans and do so entirely on their own. The second parallel is the spatial parallel, which is the idea that a lot of the things that we do in physical space are increasingly being done in the virtual space. And we can look to examples such as e-commerce and socializing and many others. So in essence, we no longer need physical spaces to work, play, shop, or socialize. Now, none of this would be achievable without the underlying technologies that make this possible, namely semiconductors and software. And these are the driving force behind things like robotics, artificial intelligence, quantum computing, the Internet of Things, 5G, and autonomous vehicles and drones. Today, we are seeing a technological shakeup across many industries and end markets. And this is characterized by a greater need for speed and accuracy, better lead times, and lower costs. So at Rasameel, we intend to invest across the autonomous revolution value chain through many investment opportunities, namely semiconductors, sensors, cloud computing, artificial intelligence, and tech infrastructure. So speaking of semiconductors, we believe the semiconductor investment rationale is stronger than it's ever been, as semiconductors have become highly ubiquitous in everyday life. Semiconductor stocks trade at attractive valuations, and they boast better than ever free cash flow generation, with many catalysts driving growth forward. And we can just look at classic examples within the semiconductor space, an AMD, for example, for evidence of this. The company has doubled revenue from data centers, and EPS has more than doubled over the course of a year or year and a half. So moving on, artificial intelligence specific chips are the main catalyst behind this autonomous revolution. We have seen in a couple of years, 2 or 3 years ago, machine-generated data has surpassed human-generated data, and moving forward, this gap will only widen. Moreover, semiconductor revenue has grown from about 46 billion 30 years ago to reaching approximately 500 billion, and it is expected to reach as high as 1 trillion by 2030. And this will be mainly driven by demand for AI and machine learning applications. From an investment perspective, it is known that AI chips command about 2 to 3 times higher prices than standard memory ones. So this should further support semiconductor growth going forward. And I'd like to just close with saying a report recently published by McKinsey predicts that about 400 to 800 jobs worldwide would be displaced by technology by the year 2025. So we've seen with the outbreak of the pandemic, a lot of technological advancements have really intensified significantly. A good example of this is the work from home model, which was adopted very rapidly. We've seen a clear shift to the app economy, and it has also picked up pace. So all in all, this supports our view that investing around disruptive technologies will be the main driver of outperformance. And with that, I turn it to Abdullah, who will be speaking on the opportunity set within metals and energy.
Thank you, Aziz. And you mentioned the importance of semiconductors, which are essentially made of key commodities, silica and graphene. And as we head into this energy transition, into the electrification of everything, it is becoming quite clear that we need to consume much more commodities today or in the future than in the past. So let's take copper, for example. There is 3 times the copper content in an electric vehicle compared to an internal combustion, a traditional car today, which is around 80 kilograms. And you multiply that by the expectation that we're going to have 30 million electric vehicles sold by 2030. That's around 10% of current copper production. And it's not just that, right? So you got copper will need to be consumed throughout the energy supply chain, whether it's wind turbines, solar panels, energy storage, and thousands of kilometers of transmission and distribution lines. Just to put things into context, an offshore wind turbine needs a transmission line to the mainland. 1 meter of that transition line has 50 kilograms of copper. So it's just enormous demand growth. And the reality is around 200 copper mines will run out by 2035. And there has been no major copper discovery in the last 20 years. So we're heading into a supply deficit that will need to raise the price of copper to incentivize miners to increase their exploration budgets to go out and find more copper, because we're going to need it. So these metals and miners today have an average earnings yield of around 13%, and some of them are distributing around 5 to 13% in dividend yields. So they're looking quite attractive relative to the rest of the market. So once you have solar and wind, you're going to need other parallel technologies to supplement the use of solar and wind. And what I mean by that is the battery. If you imagine the lithium-ion battery today with Tesla, they're working with Japanese and Chinese companies to continue on the development of batteries. And it's really a race by many vehicle manufacturers to really perfect that battery chemistry. One metal that we've identified was nickel. Nickel tends to increase the durability and the safety of a lithium-ion battery. And when you think about utility scale storage batteries, that's going to be even more important, and they consume a lot more lithium, a lot more metals in general. So nickel is quite a tricky metal to invest in. I mean, there's only 4 countries that produce nickel, and that's Indonesia, New Caledonia, Russia, and the Philippines. And it can be quite tricky to invest in these countries. So through our screening process, we've stumbled upon Canada Nickel Company, which is developing one of the largest nickel deposits in Canada. So the reason why we like this play is, one, it's a clean energy play in the sense that they have access to hydroelectric power. So a lot of their energy that they will consume will be renewable energy. And then on the production end, all that waste production is proving to be very efficient, because that waste has the power to suck carbon out of the atmosphere. And that jives really well with the needs of these electric vehicle manufacturers. So, for example, last year, I think it was the second or third quarter earnings call of Tesla, where Elon Musk said, we will give a very large contract for whoever can mine nickel in an efficient and sustainable way. So far, Tesla has given a contract to, I believe, BHP, and we believe that this is just the beginning of a trend where a lot of electric vehicle manufacturers, a lot of utility providers will seek to make sure that they have that supply as they see the supply deficits the way we see them. Also along the S-curve, and we do see nascent technologies within the hydrogen space and also the nuclear energy space, where we see a lot of advancements in technologies making nuclear energy safer and much more reliable. So we're very excited in terms of the energy transition and the outlook for metals and mining. And with that, I'll switch it over to Abdul Muhsin on healthcare.
Thank you, Abdullah, and welcome again, everybody. Healthcare, which is our second biggest sectoral exposure, represents a lot of opportunities that we see in the market. Healthcare, in its nature, with its medicine discovery and the patent system, ensure that there is always development and innovation within healthcare, whether it's medicines, equipment, or any other offerings. And that we saw clear over the past year. Some of the brightest themes that we see in healthcare are oncology and the oncology breakthroughs that we are seeing, gene editing, digital health, amongst other themes and trends. For instance, over the past 18 months or so, we saw vaccine makers scramble trying to get a vaccine onto market to stop the pandemic. And they were able to do so in blistering speed. And this was made possible by technology, which is gene editing and sequencing. Gene editing and sequencing is the ability to map out a person's entire DNA and identify which parts of the DNA corresponds with which part of the human. Like as you can see on the graphic on the right, there's various uses for this technology, as we mentioned, the vaccines and whatnot, and also to target disease, oncology medicine development, and also it extends to past healthcare into agriculture and modifying plants for crop yields and whatnot. This technology is not new, but is now we're seeing the fruits of the years of research and development within this field. For instance, the cost of sequencing a full human DNA was above $15 million back in 2000, whereas now it is below 1,000. So the price is now scalable to a mass market, and whereas many people can benefit from this technology. Illumina is our player in this theme that is part of our disruptive technology. Illumina is aiming to change the way that we identify or detect cancer. Their subsidiary Grail creates early cancer detection tests that will alleviate the needs for invasive procedures and whatnot, and will make the chance of identifying or catching the cancer early and fighting it early better, which is hopefully that can treat a person effectively. As my colleague said, with the Internet of Things and the integration of it within their respective sectors, this is also happening in healthcare. The telehealth solutions that we saw over the past year again or so has been alleviating the stress on healthcare institutions where they wanted to focus on the pandemic. The usage of telehealth solutions has been prevalent pre-pandemic, but the usage or the need for it in the pandemic has seen a huge surge of usage growth of this. For instance, Teledoc, which is part of our disruptive technology strategy, they have seen a 34x growth in usage from 2009 till today. And also they cited that they target a revenue growth of 25 to 30% for the next 4 years, compounded growth. And they cite the sustainability of the revenue. Now they offer like a comprehensive suite of solutions that a user can benefit from, which will alleviate stress, as we said, on healthcare institutions, where in some parts like the US, waiting times can go up to a month. So the need for this theme is prevalent, and we believe that it will continue sustainably. And with that, I move back to Rob.
Thank you very much, Abdul Muhsin, and appreciate you going through that. I was just thinking, actually, I had a bit of a smile on my face when Surin was talking about Pac-Man, because I've been in investment management for, I guess, over 30 years. And when I think back to when I was a kid, probably not even a teenager, I used to run down to the corner cafe. I'm sure many listeners may remember that as well, and play Pac-Man on a huge machine, which you'd have probably difficulty trying to get through a modern door today. And today, here we are basically talking about companies like Teledoc, where you can have a doctor on the other side of the phone with full diagnostics. We're talking about machine learning, etc. We've moved on incredibly in the last 40, 50 years. And I think the Moore's law and so forth, the technologies are just going to get faster and faster in terms of what we can do. So the opportunities is huge across semiconductors, through to healthcare, through to commodities. But at the same time, we do want to highlight to investors that this is going to be a relatively high risk portfolio. What we mean by that is there's going to be quite a bit of volatility, and it may not be volatility which is in parallel with economic activity, but the market will become expensive, and then you're going to get the sell-offs when the opportunity set improves, and then the market will become expensive again. And we need to be considerate also of the fact that there are numerous risks that we're looking at. These companies typically tend to be relatively small, the technology relatively nascent, they're new. So we need to worry about regulatory risk. We need to worry about cash flow in terms of, do they have the cash flow to sustain their marketing budgets and technology development? We need to also ensure that these companies, and we obviously spend a lot of time doing the research on that, but we need to ensure that these companies have the management capability and actually have a technological advantage to move forward in the areas that we expect them to do so. So be aware of the risks. But we think, given the fact that it's a longer term opportunity, we think that the performance will be significantly higher than average market performance. And we think that it will be worth investing in the space, even with the slightly higher risk than a typical global portfolio. In terms of process, I won't go through this slide in much detail because we've been managing to the same process now for approximately 3 years. What I would say, though, is when you look at the research side, because we have research, then we have the strategy, if you want, in terms of going through all the screening and the company research and portfolio management. Really, the big difference here is in terms of the initial process. And we're not looking, as I mentioned earlier, at companies within the normal economy. We're looking at small tech companies, healthcare companies, etc. So it's all about developing the theme. We're looking for themes that have sustainability. And on this, as I mentioned earlier, we've got these 6 core themes that we think will perform extremely well. And what I really just want to highlight here, and I think Suren did a good job of this as well, each theme that we're looking at can play on the other. So effectively, it's growth upon growth that we're looking at. Each theme is disruptive, and you have this S-curve for each of them and the potential for massive growth in each of these areas. So Suren was talking about e-commerce. You can see the ecosystem is very, very large. In terms of the underlying process, once we've developed the theme and decided which area of the theme to invest in, whether that be, for example, robotics or AI or cryptocurrencies, etc., we will then look at all the different companies within that particular space, within that theme. We'll look at all their valuations. We'll look at their financial reports for the last 10 years, if they even have 10 years of history, so typically maybe a little shorter. We'll talk to management. We'll go through their annuals. We'll look at their quarterly reports. And then we'll basically go through the typical process of looking at strengths, weaknesses, opportunities, etc., to identify those companies that we think will have the greatest potential upside and the greatest sustainability to actually succeed over the longer term. And I think it's quite interesting. You know, here we are talking today. As you can see, my colleagues are in different areas around the building and so forth. And we're all using Zoom. Zoom didn't exist 10 years back or 20 years back. Zoom is new technology, just like Teledoc. And here we are using it. It's ubiquitous. It's one of the companies we actually like currently in the DT portfolio as well. So with that, I just want to summarize by saying we are a relatively young team. I think I'm the oldest within the team. So I have that sort of longer term perspective in terms of how things have moved in the market, but Suren is perhaps the youngest, and I think is perfectly positioned to understand the gaming community and so forth. So the team is well set to understand and to analyze the opportunities at hand. We're local, so please come and chat with us. I think we're all very happy to go through the strategy and so forth. And as I mentioned earlier, we're outperforming our peer group, which is something very good to see. And with that, I'll pass it back to Ali.
Thank you very much, Rob, and thank you, gentlemen. It has been a very comprehensive coverage of the concepts of the fund. Just a little disclaimer there for regulatory purposes. All the material prepared in this webinar has been done as part of the promotional campaign of the Rasameel Disruptive Technologies Fund. All efforts have been made to make sure of the accuracy of the content. Past performances are not indicative of future performances, and any investor who's interested in this fund or any other investment for that matter need to make their own assessment and their own due diligence. The material related to this fund can be obtained from our offices in Souq al-Safat or from our website. With that, I would like to move to the question and answer session, and we already have some questions there. The first one saying, Rasameel Innovative Technologies Fund is really epic. The question is, why shall I invest in Rasameel Fund where I have less fee ratio investing in ETFs like ARK? Is your fund managed actively or passively? And if it's managed actively, how often do you rebalance your portfolio?
So thank you, Ali. Maybe I can pick that up, and then the analysts can, one of my colleagues can step in as well. We actually, so let me talk to that. We're very actively managed. We're not a passive manager. We are very actively managed. We're constantly going through our portfolios. We review the portfolios on a weekly basis. So we sit down as a team and we basically go through the entire portfolio, looking at what's performed, what's underperformed. And for those companies that have underperformed, we then have a Q&A session with the analyst, because typically you'll have the analyst that will come up with the ideas and the names. And then it goes through the process of each of us going through it and sort of poking or kicking the tires, as they say, to check that the companies are those companies that we want to invest in. We don't go through a strict process of churning the portfolio. As I mentioned earlier, we're spending the time to try and come up with the names that we think we can invest in long term. So if we have a name in there, for example, that is in the portfolio for 3, 4, 5, 6, 10 years, so much the better. So we want to minimize trading. We want to spend our time up front getting the right companies. In terms of performance, and I should just mention, we're obviously Sharia compliant. Many of the peer group and the benchmarks that we use are not Sharia compliant. Now, what's interesting here is within our peer group, we have ARC Innovation Fund, for example, which is very well known. That's an ETF. You've got the iShares Exponential Technology Fund, which I think is relatively small, but most investors can tap into that as well. We're actually outperforming these guys quite nicely. So our expectation is that we will underperform in an up market, but we'll outperform in a down market, i.e. we won't have the same level of volatility as many other funds. So right now, for example, we're outperforming the iShares Exponential Tech by around 2%. We're outperforming ARC by around 8%. So ARC is down by around 11% year to date. We're down, unfortunately, by 2.7%, but I mentioned earlier on that the environment is improving. Many of the companies that we look at and we like, that we thought were too expensive half a year ago, are down anything from 30 to 50%. So for us, the opportunity set is improving. It's a better time to invest today than it was 6 months ago, which I think is very promising. And we also outperformed ARC last year. So, we hold companies like ARC in a relatively high degree. They're a very large, successful ETF, but we think we have the team to hold our own and compete against them. And as I mentioned, we're very actively managed. So if we see the need to get out of the market altogether, we can adjust our allocations accordingly.
Thank you, Rob. The following question says, how do these publicly traded disruptive companies compare to private companies in the VC space in terms of prevalence of the adoption of the technology and the stage they are in, respectively?
So I'll address that real quick. I mean, I think obviously VC is more early stage venture capital. So that's very early stage. Rasameel itself does have allocations to the VC market. I'm sure our clients are aware of that, and technology funds as well. So we are investing in companies that have gone through the VC, the private equity stage, and are obviously listed. So they're going to be anything from a couple of $100 million up to a few billion, if not larger. For example, Tesla would be potentially one of the companies we would have in the portfolio. That's obviously not a VC company, but has been incredibly successful as a listed entity. So we're only playing the listed markets. We don't think that holds us back. It does provide us with a lot more liquidity. It also provides us with a degree of comfort in that these companies and management teams and the technology have got through the VC process. They've already had stage 1, stage 2, stage 3 financing. They're now listed and in many cases have access to incredibly cheap debt financing, or should they need to, equity raising as well. So, Tesla, for example, if you pulled up a price chart of that, I think that's probably more successful than most VC companies we see out there. The other thing that I would say with this as well is to do VC, you do need to invest in a fairly broad range of companies in the hope that 2 or 3 out of the 10 succeed. We're a little bit more concentrated. We're still very diverse relative to some of our other strategies, but at the same time, we're more concentrated than, for example, a VC.
Okay, another question here says, you haven't mentioned anything on the cybersecurity space being an industry that falls within the disruptive technologies position, like Palo Alto Networks, CrowdStrike, and something like that. So who would like to take that?
So I think Abdulaziz is perfectly capable to pick that one up. And actually, we do have a focus on that within the DT strategy as well.
Yes, definitely we do. Cybersecurity is one of the main sub-themes, I would say, within IT. And we do have a bias to cybersecurity companies that have strong or above average leverage to subscription-based revenues. So companies that exhibit a subscription-based model are ones that we like. We know that they are trading on high valuations now, but over the last 2 to 3 months, we've seen sell-off across software and as well as cybersecurity. So we are we're monitoring the space. Actually, in fact, we CrowdStrike Holdings is a recent holding that we've added to our strategy. So it is a space that we are looking at very closely.
Thank you. Another question. What are the hedging process that you use for the fund?
So we don't hedge. It's obviously very difficult to hedge within Sharia compliancy. We're not allowed to do shorts, and that's not the nature of the fund itself. We want to be relatively fully allocated. We want to be invested in the market. So to address hedging, what we will do is we'll look across different themes, and some themes may have a negative correlation to one another. Some will be very correlated. We're also looking to invest in areas and themes that some of the peer group or the benchmark won't be investing in. And for example, Abdullah was talking about the fact that we invest in lithium, we invest in copper, nickel. So these are areas that we think are absolutely core to a successful disruptive technology theme. You need all of these commodities in order for DT to function, for the technology to function. But those same areas, those commodities are not necessarily in our peer group. So that provides us with a little bit of hedging as well, I think. But generally, we are fully invested.
Thank you. A question to you, Abdulaziz, since you've mentioned the semiconductors. Does the shortages in semiconductors have an impact on some of the companies you are planning to invest in through the Rasameel Disruptive Technologies Fund? And how do you see these shortages playing out in the short term?
Yes. So the issue of semiconductor production has really come to the forefront over the last 2 to 3 years. If you remember, in 2018, we had sort of a tit-for-tat trade war that started off between the US and China. And this has really, the issue has really heightened over the last year or two with the pandemic. And believe it or not, 40% of semiconductor revenues are derived from the US or US listed companies. However, only 10 to 15% of production comes from the US. So we can clearly see that there is a big shortage in terms of US semiconductor production that the US is really trying to address over the last year or so. So we've had the recent infrastructure bill as an attempt to address that, and about $50 to $55 billion has been devoted to the US CHIPS Act. So the implication of this is that there will be a lot of repatriation of production. They will try to bring back a lot of production to the US, and this really bodes well for a lot of the semiconductor equipment companies that we are invested in. And we have an overweight position to semiconductor equipment, both upstream and downstream companies. So I would say yes, the shortage could lead to a headwind, sort of, but on a more positive note, we are seeing semiconductor companies that are sporting order books that are stretching beyond the next year or two. So some foundries like Global Foundries or Taiwan Semiconductor have order books that are stretching out up to 2024. So this is really helping margins. Gross margins are improving. Free cash flow is improving as a result of this.
Both Serene and Rob mentioned cryptocurrencies. Would the fund be investing into cryptocurrencies, being a Sharia compliant fund?
So I'll pick that up, and then I think Aziz can follow up on that. We've actually looked at cryptocurrencies. We wanted to include them in the DT fund. The reality is that they are not an approved investment vehicle or an approved currency or a product by the regulators. So unfortunately, we can't include. And then also one has issues in terms of custody. Where would we custodize the assets. So we found other ways to invest in cryptocurrencies. And I'll let Aziz talk to that. Before he does, though, what I would say is the following. We like cryptocurrencies on the longer term. So things like Bitcoin, Ethereum, ADA, etc. We think they have much higher upside going forward. But it's very difficult to see where they'll go on the short term. So on the longer term, we can argue that they're going to become ubiquitous, that the market is going to grow exponentially, as Surin was talking to. Short term, there could be a lot of volatility, so we should be expecting that. And then Aziz, do you want to talk real brief about Riot?
Yeah, just to add to what you said, Rob, we're also believers in the debasement of fiat currency. So we believe that cryptocurrencies will be a beneficiary of that. Also, as a hedge to inflation in the short to medium term, we think that cryptocurrencies should cryptocurrency prices should really be supported by rising inflation. With regards to taking exposure in the disruptive technology strategy to cryptocurrencies, as Rob said, we do not hold the actual cryptocurrencies. But we invest around the cryptocurrency ecosystem through things like brokerage platforms or publicly listed miners that are Sharia compliant. So one of these publicly listed cryptocurrency miners is Riot Blockchain. It is a Sharia compliant company and has about 3 to 4% market share of the total hash rate of Bitcoin. So we're very positive on this one. It is the whole space is volatile and closely tracks Bitcoin price, which we have seen over the last 2 to 3 months has been very volatile, but we think volatility should subside over the medium to long term, and we should really start bearing the fruits of having exposure to Bitcoin.
Okay, as a Sharia compliant fund, would the fund be paying the zakat on behalf of the investors?
Abdul Muhsin, I'll let you pick up on that one.
I think he's disconnected.
I can pick it up. So the fund doesn't pay the zakat for investors directly, but what we do is every year we will calculate the zakat on the fund, and that will be printed in the publications and to our clients. The fund, as a Sharia compliant, will need to go through purification processes, which Rasameel takes upon itself to do. But the zakat has to always come from the investor's personal end.
Thank you very much. Now, what benchmark will be using to compare your performance of the fund?
So Ali, that's a great question. We discussed this actually just before the call. There are not very many benchmarks that are Sharia compliant. So we use a range of peer group analysis and benchmark. The only compliant benchmark would be the MSCI World Islamic, which is one of the benchmarks we will use. The core benchmark that we will use is the iShares Exponential Tech. So that's ticker code XT, which is listed in the US. That's one that we'll track, which has got a very large allocation to both technology and to healthcare. So we will probably be a little bit more diversified, and we'll have a little bit more in materials, for example, than they would. We also obviously track the NASDAQ, which you could argue is an internal benchmark as well, but the NASDAQ is very focused on the US, whilst we are very global. And then we look at ARK as well. We use the ARK ETF because it's obviously very well known and is one of the large ETFs out there. So it's one that we do track. I think Ali, actually, if you'd like to mention, because I think you could mention the fees and the hurdle rates that we use as well. That'd be very good.
Yeah, as you mentioned, the fund is targeting an absolute return, and therefore the performance fees will be 10/10. The fund will be charging a management fees that's tranched based on the amount. The fund will accept investments with a minimum of $50,000. with a weekly liquidity. So clients who are investing in the fund have constant access to their funds. One more thing, many questions I've been seeing here talking about opportunities within the startup business and venture capital opportunities. The fund is only dedicated to public equities that are within the disruptive technologies realm. We do have a venture capital fund that looks at venture capital opportunities within the region, but whoever have any interest in this area will need to contact us to discuss such opportunities. But for the disruptive technologies fund, it is focused only on the public equities. There is a question here on the opportunities there that lies in the metaverse. I know, Sureen, you've mentioned that we don't have a clear idea yet on the final look and shape of the metaverse, but what could be potential opportunities that could arise from the development of the metaverse?
Thank you, Ali. And to be frank, I was actually looking forward to this question, so I'm very glad that it came up. So I'll just reiterate what I said earlier. At this point in time, we know very little about the end state of the metaverse. What we do know is that companies are actively investing today in order to build that vision into reality. It may be decades away, but that's fine, because we know that the investments to make that happen are going in today. So just around that, how we've mapped it out is that we focus on the hardware or the core metaverse. These are companies that will be building the base layer of the metaverse. So this would include semiconductors, memory, 5G, broadband, everything that Aziz spoke to earlier. Then we move on to the outer layer where we talk about software. Now, software is the component that is going to be designing it and hosting it. That's where we come. That's where we talk about cybersecurity, about Internet of Things, cloud computing, design software, etc. So that gets covered there. And then finally, we talk about the areas that I spoke about within e-commerce, about the actual businesses that will provide a use case inside the metaverse. So here we see opportunities across gaming, which I spoke about in detail, through e-commerce, through social experiences like social media, entertainment, etc. And then we finally move on to, let's say, the other aspects of life, like socializing, work, fitness, healthcare, etc. So while it's fair to say that a lot of the vision will only be conceptualized later on, the investment opportunities we see are as of today.
Thank you, Sureen. I just wanted to highlight one more point. I mean, you can always get in touch with us either on our hotline, which is 222-52-414. That is 222-52-414, or through our website, rasameel.com. Another question here talks about, or asking about, the concentration of the portfolio. How big of a portfolio of companies would the fund be looking to invest in?
So I'll pick that up. Typically, we would target a portfolio size of around 20 to 30 companies maximum. So if you look at the global strategy, for example, we've got around 35 companies in there, but the core holding, the large core holding, would be around 10 names. And ideally, for most of the strategies and portfolios we run, we want to be fairly concentrated. For the disruptive technology portfolio, our plan will be to be much more diversified. As I mentioned earlier, these companies are fairly nascent. They're small. So we may have a few positions that will get up to the 5% level in terms of allocation, but most will be relatively small. And in some cases, what we are doing is when the team finds an interesting name, we'll add them into the portfolio as 0.5%. We'll then track it for a month or two or a couple of quarters. And then as we gain more comfort with the name, we'll then add to that security going forward. So, you know, we don't want to we don't want to jump into names too quickly. We're trying to spend the time up front, have a diversified portfolio. And then over time, our expectation is that we'd concentrated more and more and more.
Would there be any sector restrictions or allocation in the fund?
No, they wouldn't be, but we're obviously going to be concentrated in the technology space when we talk about sectors per se. So technology would be hardware, software, which would include semiconductors and so forth. We'd be focused on healthcare. We see that as a core area within the DT theme. We've got some commodity exposure as well, obviously, and then e-commerce exposure. So the core grouping will be in tech and healthcare, and then we'll have exposure on the periphery around that.
And the last question I have here on the Q&A section is, with valuations still being considered high, what headwinds would you possibly highlight for this year that could have a direct impact on the fund's performance?
Yeah, I mean, that's an interesting one to answer. And actually, we've just done an outlook for 2022, which all the clients should have. And anybody listening on this webinar can simply reach out and ask for a copy of that. And in that, we go through our expectations in terms of interest rates, growth, and inflation for this year. I'll talk to this in generalities. The market, and particularly the NASDAQ, is relatively expensive. We shouldn't try and kid ourselves. The market is expensive. But the bulk of the expense, if you want to call it that, the bulk of the NASDAQ that is expensive are the large caps, the Googles, the Apples, the Amazons. These are very large cap names, and they've been around for a long time, but they're now trading at 35 times earnings. So our actual focus is, as I mentioned, on the much smaller companies, right? So we got JD, which is a very small, I mean, relatively small company. It's 100 billion plus, but it's a small company within the context of an Amazon and so forth. And then we invest in smaller companies in technology space as well. And what's critical here is the fact that, let me put it like this: the valuations have come down significantly in the last 6 months. So whilst the NASDAQ has been fairly well supported in the last 6 months as a whole, and we've seen the NASDAQ performing well, within that we've seen numerous names actually selling off significantly and are significantly below their 200-day moving average and significantly below the levels that they were back in March. One of the reasons for this sell-off, if you want, of these names is the fact that you have talk of a rising rate environment. So the market is effectively pricing in rate rises, and we've already seen that with the 10-year yield in the US going from around 1.5 to around 1.75, 1.8. And you've also got talk of taper. So those two things are basically pulling liquidity out of the system. A reduction in liquidity and higher interest rates are negative for the market overall. And that's why equities have come under a little bit of pressure on the short term. Our expectation, as highlighted in the outlook, and we do plan to do a webinar on this at some point in time, is the fact that inflation will likely peak in the next month or two. We actually think it will probably peak in sort of January, February at the latest, and then come off significantly. So by year end, we're probably talking about inflation hitting around 3%. And the reason why inflation by year end is not below 3% is because we still see all these government controls and so forth around COVID, most likely impacting supply chains. So we still anticipate a degree of supply chain disruption, but much lower levels of inflation, and also most likely an economy globally and the US, which will be weaker than current expectations. So the market is anticipating that the US GDP growth will be around 3.9%. That's already below 4%, which was a month back. Our expectation is that it's going to be something around the sort of 3.5% rate. Now, why do I say that? That's a headwind on one side. It's a headwind potentially for many parts of the security space, both negative for bonds and equities potentially in some areas. For DT, however, it also means that the cost of financing will remain low. And as I mentioned, DT is not economically sensitive. DT is focused on growth 5, 10, 15 years out. So actually, we anticipate that the environment for DT will potentially improve quite nicely as the year progresses. And we think right now, it's actually quite a nice time to be taking allocation because you have had this sell-off. Just before I leave this point, many of these companies that we looked at, we liked, but were too expensive 6 months back, are now trading at levels that we saw prior COVID, so early 2020, late 2019. And we think they may start to come off a little bit further, but we think the opportunity is now ripe to start adding to these exposures.
Well, thank you very much, gentlemen. It has been a very eye-opening opportunity to understand what lies ahead in the market and with the disruptive technologies being developed in all sectors. I would like to thank everybody for their attendance with us. It's always a pleasure to have you around in our webinars, and I would wish you a very good evening and stay safe. Thank you very much.
Thank you very much, all. Appreciate it.
Thank you, everyone.
Great year ahead.
Thank you.